cap rates. This is an event that we hold twice a year. Ariel Property Advisors, our company, hosted. My name is Shimon Shkury. I'm the president of Ariel Property Advisors. Our company is a real estate services firm, covers New York City, and we have three main disciplines. The first is the investment sales discipline. We're brokers of our company, sell buildings throughout the city of New York. The second is our capital services market group, where our capital services professionals place debt and equity with our clients. And the third is our investment research division. Many of the reports that you see here on your table this morning, and much of the information that I will present soon and will be in front of you, is produced by our investment research professionals and analysts. This morning, I'm going to speak for about 10 or 15 minutes about the market, what we've seen, summarizing some of the findings from our reports and understanding of the market for the first 6 months of 2016. And then we're going to hand it off to Michael Stoller, who needs no introduction, to moderate a panel with three very active players in the market. Qahir Madhany from Blackstone, Jason Hart from the Carlyle Group, and Ben Curtis of Kushner Companies, all of which are here with us today, and I want to thank you for coming and thank you for supporting also our cause. Before we start with the official program, I'd like to speak briefly about the cause that we're supporting this morning, legal outreach. We've been involved with the program for the past decade. It's an after-school program for kids who better their chances to get into colleges and have a significant success rate, something that I'm really happy to discuss with anybody who wants. I think that what's unique about this program is really their executive director, James O'Neill. James decided to start a nonprofit right after Harvard Law School, which is not traditional. And I really got to know him better over the years and think he's a fantastic guy and someone that I'm so proud to be associated with. James, if you don't mind, please come to the stage. We'd like you to speak for a few minutes, and then we'll show a very brief video of the program, and then we'll start with a professional program. Thank you.
So obviously, I'd like to say good morning to everyone. Good morning. Okay. Just wanted to make sure everybody was alive and well. As Shimon mentioned, my name is James O'Neill. I'm the Executive Director, Co-Founder of Legal Outreach. And contrary to what you might think, we're not a legal services organization, but as Shimon mentioned, we are indeed a college prep organization working with students after school on Saturdays and every summer to help them realize their potential. Our students come from some of the most underserved communities within New York City. We recruit from all the boroughs, except for Staten Island, unfortunately, just because of the distance. And these students come to us with a question in mind. And that question is this: how do I get to the rest of the world from here? They are very isolated in their communities, so when they talk about here, they're talking about where they grew up or where they're growing up. Oftentimes communities where they don't come in contact with a lot of professionals. Oftentimes communities that are beset with problems. Yet they want to know this can't be all that life has to offer. And when they ask that question about how do I get to the rest of the world, they're really talking about how do I get to where you are, in your companies, in your businesses, in your firms. They want to know the path. And all they're looking for is an opportunity. And we're grateful to Ariel Property Advisors for opening the door to their firm so that Kids literally spend a week there, learn a lot about the real estate markets, the real estate practice. They come away with a vision of what's possible for their lives. You can join this effort. Those of you who are here who really want to do your part, and you want to do it in such a way where it won't take a lot of time, but you can make a significant difference, we're the organization you should partner with. So after all of this is over, I'll be outside. I'm happy to give you my card, happy to take your card, happy to meet with you, and we can start planning what you might be able to do to better serve these young people. Lastly, I'd just like to say that your efforts are not just a one-time thing that makes a difference for that 1 week. As a result of what Ariel Property Advisors is doing and others, these young people become motivated to take full advantage of their educations. They develop the academic skills they need in order to get into some of the best colleges in the nation. So you can be a part of that. You can ignite that fire. So I'm hoping to talk with many of you after this is over. Thank you so much, Shimon. Thank all of you for listening.
I actually have the opportunity to work as a team and like propose ideas to brokers and work alongside brokers and see what they do. A lot of kids watch stuff like this on TV, but I actually get to live it in the moment in reality. So I think that's pretty cool for me.
I realized that college is not a walk in the park. Legal outreach has shown me that you need to put in hard work, be persistent, and you need to persevere in order to get into a good college. This internship was very fun. It has really helped me in my communication and presentation skills.
A real estate company is cool because you don't know what really happens behind the selling. There's a lot more to it with the law incorporated, so it's cool.
My background is in law. I went to law school, passed the bar, practiced for a very brief period of time. But what I saw was that there was a need to get more minorities, most especially within the legal profession, and decided to start this not-for-profit called Legal Outreach. And the objective of the organization was to get kids interested in law as a potential career, but even more so, we wanted to prepare them to actively pursue that career. We didn't want it to be just a pipe dream for them.
After joining Legal Outreach, I learned to not only do what was asked of me, but to do it with excellence and to exceed standards.
At Ariel, we're always striving to do better. In addition to real estate, we want to grow as professionals, as we want to grow personally. We want to do great in our industry, and we also want to give back.
James, thank you, Legal Outreach. And the money that you paid for tickets this morning is 100% of it goes to Legal Outreach, and our Real Property Advisors will also give a nice donation on top of that. So we want to thank everybody here for contributing. We'll start with the program. I'm going to really speak about the first 6 months of 2016. And I'm going to describe what we've seen in terms of volume, dollar volume of transactions, and in terms of pricing from each one of the asset classes. We're going to also dive into the boroughs to see more specifically each one of the boroughs and what happened there. We had overall a pretty good first half of 2016. If we look at the numbers, we see that the volume of transactions did decline by about 8%. I think a lot less than expected as of the end of last year. In terms of the specific boroughs, we start with Madhany, below 96th Street, where in terms of dollar volume, we've seen a decline of 13% compared to the year before. And another thing to mention here is 24% of property volume. So larger transactions still dominate. The smaller transactions transact a lot less comparatively speaking, but overall dollar volume went down 13%. To qualify this, one of the transactions that took place last year, or the second half of 15, is the Skytown transaction for $5.5 billion. Taking out that specific transaction and compare it to the first half of this year, there was actually an increase in dollar volume of about 15%. So the market is still doing well in terms of volume, even in Manhattan below 96th Street. Pricing-wise, the multifamily market in Manhattan below 96th Street stayed flat. It did not go up or down for the first 6 months of 2016 compared to the 6 months prior. Development pricing, almost flat, up 1%. Land values are 1% on average. And commercial, office and retail are up 12% compared to the 6 months prior. The retail market, specifically in extremely good locations and lucrative locations like Soho and along Fifth Avenue, have seen higher vacancy rates, 25 to 31%. Asking prices in these locations are about 10% higher compared to the year before. What's happening is that landlords are waiting for the right tenants to get in. And one of the examples is 685 Fifth Avenue, which was purchased by Thor Equities in 2014 and got its tenant coach in 2016. A lot of TI, but $4,000 a foot. So that's a trend that we're seeing in good located retail corridors. High vacancy, higher asking rents, and owners that are waiting for the right tenant. The next borough, not surprisingly, is Brooklyn. Brooklyn has seen almost no decline in volume of transactions, only 2% decline compared to the 6 months prior. Pricing, however, went up. We're talking about 11% higher multifamily pricing compared to the 6 months prior. Development market went down only 2%. Commercial up 8%. You look at land values, we see very similar to Manhattan below 96th Street, a 13% drop in volume, on dollar volume of transactions for land. Price per buildable foot on average $241. The residential rental market is expecting to absorb about a little less than 6,100 units for 2016. Only 8% of them are condominium units. So the balance are residential rental units. And if you look at the residential rental market overall, you see a 4% increase year over year in the rental market. That should be also qualified because the concessions that we're seeing has doubled in terms of the number of units that receive concessions. So if we have 3% of the units receiving concessions last year, we have about 6% this year, which could pretty much wash that growth. So we are expecting an absorption period in Brooklyn, probably for the next 12 to 18 months, but we're expecting rental prices to keep going up right after that. The Queens market, a 15% drop in terms of dollar volume. Multifamily market has done well, 6% increase, and the development market about 15% increase compared to the year prior. Queens, we know about Long Island City, we know about Astoria. One of the interesting parts for Queens is transportation. And one of the things we looked at is the 7 train, as an example. If you look at the 7 train stations, and you look at Hudson Yards, a 2-bedroom on average is renting for $4,700 a month. If you go 2 substation stops to Long Island City, that price drops to $2,900. But that's not the end of the story. Go all the way down to Flushing, a 20-minute train ride, and you see that the price is closer to $2,000 a unit. And that tells us that there is a lot of growth opportunity along these lines, specifically rental growth. And the testament to that are transactions that started to happen at much higher numbers and values in the first 6 months of 2016. A&E purchased a deal for $72 million in Jackson Heights for $376 a foot, a little bit less than a 4 count. Norcorp purchased a $17 million deal in Sunnyside for $360 a foot, about a 3.6 count. 14 and 15 times rent. These numbers we haven't seen in Queens so far, and we believe that investors are realizing the potential in this specific submarket. Northern Manhattan has done extremely well in terms of transaction volume, a 60% increase year over year. The average transaction in general went up from 8 to 13, which is drastic compared to the year prior. And in terms of pricing, multifamily pricing has gone up 12% for the first 6 months of the year. Development market went up 13%, and commercial 7%. So we really see that investors believe that market was underpriced in the beginning of the year, and the transactions actually prove that. In terms of land values, we've seen land trading in areas like Adam Plain Powell and 151st Street, which are further up in Northern Manhattan, for about $240 a foot, closer to the averages that are in Brooklyn. We haven't seen that in this cycle yet, so and it's justified. We think that the Brooklyn market and the Northern Manhattan market, to some extent, have similarities. If you go down closer to the Upper East or Upper West, prices per buildable are going to be closer to $400. For example, Madison and 110, we've seen a transaction that go through there for about $391 a foot. Investors believe in the Second Avenue sublane, the possibility of rezoning. The Bronx dropped about 4% in terms of dollar volume of transactions for the first 6 months of the year. Multifamily prices went up 11%, development 15%, and commercial 11% as well. In terms of the multifamily market, we're seeing a continued trend in the Bronx, very similar to Northern Manhattan, where investors are seeing still an opportunity at 11.5 times rent, around a 5 cap for multifamily buildings. The interesting part about the Bronx is also the industrial market, who's done extremely well and went up in terms of dollar volume of transactions the first 6 months of the year. We're talking about prices per foot on average for industrial of about $175. Very low compared to most parts of the city in terms of industrial, and allows companies like Fresh Direct and Silver Cup to go into the Bronx, as well as the developers to convert buildings, industrial buildings, to office and commercial in general. Capital markets are interesting today in the first 6 months of the year. The conventional lenders are slowed down in terms of construction loans, but that's known. What we should know as well is that for multifamily, they've been a lot more careful, especially where their loan to values and who they're lending to. What's interesting that's happening and has happened since more than the beginning of the year is fund lenders and alternative lenders and transitional lenders. Those that provide money for assets that are in transition, not pure developments. A lot of them are multifamily. Leverages are up 75, sometimes 80%, and the cost is about 100 to 150 basis points higher than conventional, which is not terrible, but very interesting form of financing. International capital is still getting into the city in a big way. Brexit definitely helped. And we are also seeing some investors, owners, and operators, we'll hear about that more, that are getting into the lending space. So in short, and to summarize, we think that the first 6 months of the year are somewhat of a result, some of it is a result of the end of 2015. Things that went into contracts closed, and things that were cooking at the beginning of the year took place in the first 6 months. However, we also should look for the next 6 months of the year. We should look about the global economic uncertainty, and as I mentioned, capital from overseas will keep coming in here and is probably doing it in a bigger way. We're talking to people and to institutions from overseas that are telling us that their allocation to the U.S. specifically is higher today. We should look at the city administration carefully. We know that they didn't help with regards to the 421A or new construction. They actually limited the ability to convert and stabilize units to fair market, which in return could also have a positive effect over time on market rates. Diversification of tenancy is big in the city, and this is something that we've discussed before. Technology, advertising, media, information are new industries that are definitely vibrant and strong in the city. Interest rates are expected to stay low. So the next 6 months of the year, if we had to predict, are going to be probably lower in terms of volume of transactions, but pricing is expected to stay the same or go higher a bit. Probably not higher at the same rate that we've seen now, but it will not, we're not expecting it to go down. So definitely a lot of statistics and a lot of information, good first 6 months of the year, and the next are expected to be more or less the same. That concludes my presentation, and with that, I would like to hand over the discussion to Michael Stoller, who's the managing director at Madison Realty Capital, and also the person behind the Stoller Show. He needs no introduction. He's an amazing friend, and I appreciate you being here. I also want to thank again Qahir Madhany from Blackstone, Jason Hart from Carlyle, and Ben Curtis from Kushner. Thank you.
You know, first of all, there are seats up front, so when do you have to stand? There are plenty of seats up front, so please come up. And the second thing is it's too warm in here, with the exception of my panelists who want to keep and schwitz. I take my jacket off, so take your jacket off and relax. Because by the time we're finished, they're going to be sweating. I promise that. Listening to the statistician, I have a new statistician here, Shimon now. He's given me some insight on some questions that I can ask each and every one about. Because I've done a lot of research on each and every one to find out. Qahir, you like multifamily, right? I mean, a couple of apartments you bought on First Avenue. What's the position of Blackstone today in the rent-regulated multifamily area?
I think we're generally very supportive of the administration and their goal to increase the number of rent-stabilized units. Our partnership with the city on Stuyvesant Town has been very successful. We've implemented an affordable program, and we just think it's very important to the community, the mesh of New York City. Generally, on a high level, multifamily we continue to see as a very attractive business to be in. We think, nationally, you're seeing a shortage of completions for single-family and multifamily homes, and it's a trend we expect to continue. And we're very bullish on New York City multifamily because for a number of years now, supply has been close to zero. And if you look at new supply that's coming, it's on the higher end. Replacement costs are very high, so we tend to believe in continued growth in multifamily kind of piece.
Now, you've continued your trend this year, purchasing more multifamily, right?
We're a very large owner of multifamily across the U.S. We transacted on 2 transactions last year in New York City where we bought over 12,000 units, and we continue to look at new opportunities.
Historically, we've been a large equity provider to condo developers over the last probably 10 to 12 years. We're a high yield seeking investor, so 20% IRRs or higher. Over the last decade or so, that's been one of the main areas where you can get those type of returns, is through condo development, at least from an underwriting perspective. So we've probably been, if I had to guess, the largest equity provider to condo developers throughout the city over the last decade. We like it. We started to think about this space about 12, 15 years ago in New York. And New York is a very unique place in that if you look at the home ownership rates compared to the rest of the country, it's essentially the inverse of what the rest of the country is. So going back, our largest deal we did condo development wise was Riverside South, over on the west side, right on the highway, with Gary Barnett. And at that time, I think the stats were roughly 80% of the city's residents were renters, and only 20% were owners. That number's now gone up. I think it's closer now today, about 75-25 ratio. But then of that 20%, roughly 80% of that 20% was in the form of co-op ownership. So the number of condo units that people own in the city, very, very tiny sliver. So we just thought there was a big opportunity to come in and provide state-of-the-art new product. People always like new, whether it's a new car, new home, new clothes, in a form of ownership that essentially hadn't really taken off in the city. Co-ops are great, but when you're trying to sell from a liquidity perspective, having to go to your co-op board and get that approval can be a major hurdle. So we just thought that in buyers, the fact that you can go in, own your own asset, get the tax advantages of a mortgage deduction, and then obviously build wealth as prices hopefully go up. It was just a good area to be in, and then the fact that your liquidity, you don't have to go ask someone permission to essentially sell what is probably your single largest asset. So that was really the long answer, I know, but why we like the condo space in general.
But here's a question for anyone to answer, but specifically for you. I noticed that recently you acquired a property, I believe, on the west side for a condo, like on 81st Street.
81st Street.
Okay, and then you've also acquired a property, which I had seen on 30th and 5th, or
30th and 6th.
And 6th over there. And the question was affordable condos, which is what is an affordable condo. And in the program on the 30th is, you're saying that they'll sell for like $2,200 a foot. What do we consider affordable, especially since you're doing something on Kent Avenue and other markets? Where do you see the market? Because, the generic press comments are, high-end condos aren't selling, low-price condos are selling, but people still need a deposit to be able to buy a low-price condo.
Yeah, so we think that affordable, I know it probably sounds silly to say that, especially people outside of New York City, is below $2,000 a foot. So at 30th and 6th, we do view that as kind of an entry condo for probably most of our buyers, the first-time buyers. And so far, we're roughly 1/3 sold out at prices. I think we're right now on what's been sold just at $2,000 a foot. And why we think that is was a good investment decision is that you look around that surrounding neighborhood, and that surrounding neighborhood is absolutely changing by the day and only getting better, we think. But if you look at what the rental rates are, and you just do the rent versus buy analysis, it's compelling as a buyer, and that's just mainly driven by where interest rates are today. The fact that you can borrow 80% as a condo buyer, you get a 10-year interest only at, let's call it 3.5%. So you do that math and figure out what your monthly carry is. It's at or slightly below what you would pay for a similar type rental unit in that location. So any place, whether that's Manhattan, Brooklyn, Queens, where we can do that math and look at that rent versus buy analysis, we're going to take a long, hard look at that too.
You mentioned Kent Avenue. We did the same exact analysis as well, where the rental rates are $65, $70 a foot at times, and our offering price is on a blend just under $1,600 a foot. So that rent versus buy ratio is very attractive for the people that live in the building and for people who are looking at it as an investment to rent to other people, or for people who want to live there. It's much better to go and buy than rent.
Qahir, what about Blackstone on condos?
Generally, what we do is the opposite. We look at the national percentage of renters, and we say, well, it's gone up 10%. And so we tend to cater nationally to the renting proportion of the U.S., and that same holds true in New York. We're not typically developers, and we're typically not condo sellers. We just, the macroeconomic trends, specifically in New York City, are employment growth, wage growth, and just a dearth of supply of rental units. So we feel like we can just cater to that sector.
Since then, it seems that you and the boys over at the Kushner companies really like Brooklyn. I mean, the Watchtower, Williamsburg, Dumbo Heights. What are you planning to do over there, and what type of market do you see?
We do really like Brooklyn. We've been very active.
Oh, I forgot the Gowanus also.
Gowanus.
Across the street from the telephone company at Whole Foods.
We've been very active there, mostly in the office and multifamily sectors. We've really found that it really started sort of 4 or 5 years ago, where we found a lot of the companies that Jared and Josh have relationships with in the technology sector have all these tenants or the companies have employees that live in Brooklyn and want to be in Brooklyn, and there's really a lack of space for them that can satisfy their needs. So Dumbo Heights is an example. We saw that there was a lot of office space with infrastructure in downtown Brooklyn, but it didn't really have a lot of character in that neighborhood. It's a little cold. And then in Dumbo, the neighborhood's very vibrant, has a lot of character, and is very attractive, but a lot of the office space there doesn't have really Class A infrastructure. Sometimes the air conditioning doesn't work, sometimes the elevators are slow. And so yeah. So we wanted to deliver a product that has both. And for tenants that are growing, that want to be in Brooklyn, but also want a Class A experience, and want to be in that sort of creative environment with character, it was really good fit.
So let me throw the same question out. Dumbo Heights, Watchtower, there is this proliferation that people believe that every industrial building can be converted into a new office building. And if you think the tape measure in New York City was a lot for loss factor, we are taking warehouses that once maybe measured 300,000 or 400,000, and now with the new tape measure, because it's no longer an industrial building, it's an office building, people are going into this. What's the feeling of Blackstone, Carlyle, and the Kushner companies with regard to the conversion of industrial to office?
For us, I think you're just a trend that we've seen for a number of years now. It's just urbanization across the U.S. And with a larger workforce and a younger workforce, they want certain things in their office space.
Are you investing in that type of?
We haven't done any large-scale conversions of industrial to office, but if you look at the reason it makes sense in a lot of parts of New York City is because a lot of office markets are underserved, like Brooklyn, Queens, up to the Bronx, and you can take a product that is somewhat obsolete and make it work for a tenancy that's excited and wants to be in a space that's open, that it encourages co-working, that encourages interaction. So I think what they're actually doing is just catering to the new workforce. I think it makes a lot of sense.
Jason?
Yeah, we haven't done any yet. We've looked at a number of deals, and I would say come close to some of these office conversion deals in Brooklyn and Long Island City. But at the end of the day, the numbers just didn't get us quite to where we wanted to be. So conceptually, I would say we believe in it. I think one trend that's helping is you just look at what's going on in Midtown South. Midtown South, where rents used to be $35 a foot, today they're $70, $80, $90 a foot in some individual building instances. And those tenants that used to be there, they need to go somewhere, and where are they going to go? I would say they're going to go to Brooklyn and Long Island City, where they can get similar type space, close to subways, and get that $40 to $45 a foot type rental number that they need to basically make their business make sense.
And I think we really we focus on really prime areas of Brooklyn, and we focus on the end user. And for the end user, it's less about what's the loss factor for office versus industrial. It's how many people can I fit in this space, and is this where I want to locate my company for the long term? And that's how we've tried to focus our commercial business.
In the same vein, this big discussion today. Last year, the largest lessor of space in the city of New York was WeWork, with about 2.7 million square feet. The proliferation of the WeWorks and the co-working, how do you see that today? Do you see it growing? Because there are other companies like Industrious. There are about 25 other co-working companies, and in reality, Regis was the first co-working company. How do you look at that just in general as a trend? Any thoughts?
I mean, as a trend, I think it will probably continue. If you look at anything nationwide, it's what everyone's talking about. What's really driving a certain investment decision is what are the millennials doing? What are they doing working-wise? What are they doing lifestyle-wise? That's why you've seen the increase in renter versus owners, you mentioned earlier. So they tend to hold a job for a year, 2 years, maybe 3 years, and then move on. They like to jump around from city to city. They like to essentially be one-off consultants and essentially be their own boss. So if you think about that trend at a very high level, then the WeWorks of the world, you say, well, there's a lot of demand there, so you would expect the supply to be there. So I think I get that from a conceptual point of view, and from a demographic point of view. I think the question, and nobody knows the answer, and we'll find out, is what happens in a downturn.
One ending of itself, I think you've seen certain parts of the market come down a little bit from where they might have been trading a year or two ago, but there are definitely a lot of segments in the market that continue to be strong and continue to have robust demand.
So in general, would you say the world is still pretty good, the two of you?
Yeah, I mean, I feel like if you just look at the macroeconomic data, unemployment's below 5%, the population who's working is growing, supply is below long-term averages across all sectors. Are there pockets of pain? Sure. Oil and gas has been, a tough part of the market. If you look at kind of inflation, without oil and gas, we've actually been hitting targets. So if you isolate that sector and markets that are exposed to that, you've certainly seen some pain. But generally, on the whole, when we look at the U.S. economy, we feel like we're in a pretty good place.
Yes, and I would agree with that. If I was forced to say where we are, I think a 9-inning game, we're probably somewhere, I would say 7th inning-ish. It's kind of what it feels like. But if you look at the underlying fundamentals, very different than the last cycle. A lot of that was being driven by just too much debt. Things being built with 90% leverage, 95% leverage in some instances. This go around, you just aren't seeing that. So you're not seeing the oversupply, whether it's in the office market, the housing market, that we saw last time. So from a pure fundamental supply-demand point of view, looking at, and then obviously again, there are individual submarkets where it's not true, but overall, we've been rather disciplined as a investment community, and obviously that's been driven by the discipline that the banks have shown, whether they wanted to or not.
So since you bring up debt, let's bring up the subject which Shimon brought up before. Alternative lenders, owners, individuals, debt funds, providing capital. Ben, you're playing in that market.
Yeah, we just started the past year. It's really nothing unique. It's been pretty competitive space right now. But really a year ago, we saw a lot of deals that we weren't winning just because we felt comfortable at one basis and it ended up trading at another. But we really liked the asset, and we really liked the opportunity, and we wanted to figure out ways to participate in that. So we participated in one transaction in Brooklyn late last year, and are looking for a lot more. Just given the regulatory.
Were you the MES, the B piece, the C piece, or where were you in the capital stack, as one would say?
We participated in the whole loan, and then we sold off a senior piece later, so we can do an entire loan of any size really, and then we can close it ourselves and then bring in a participant later on.
We know that your public company, Blackstone Mortgage, is very active in that arena over there.
Yeah, I mean, we generally see opportunity in growing that business. It's already a very large business. We have a public platform that lends on more stabilized assets. We obviously have a private debt fund as well that understands real estate, provides full mortgages, full debt opportunities for transitional assets, and really understands what they're doing. And so we see opportunity as, I think we've all seen things kind of pull back, and we see opportunity just given our expertise in the business to further provide options to people buying assets.
Jason?
It's definitely a trend that I think is here, probably here to stay. We've borrowed on a number of transactions from non-banks. One debt fund, another actually we borrowed from SL Green. So it is, for us as a borrower, having another bucket of capital to go to, another lender is always a positive thing. We like competition being a borrower. But I will say the one thing we really appreciate when we're borrowing from one of those type of lenders is just the ease of which closing a transaction compared to a more traditional bank. There's just a lot more flexibility, a lot more, I would say, business sense, where if something comes up, and say, no problem, we'll handle that post-closing. Whereas a bank, just because of not their own fault, just because of the regulations, they need to check the box, and their hands are tied a lot more. So we like it at being a borrower. In terms of being in the business, we're not in the business, just on the equity side. Over the medium and long term, does that change? I don't know. But it's definitely an interesting business, but competitive one. So.
Yeah. To Jason's point, we found that to be very attractive to borrowers for us because the regulatory environment has become so restrictive that banks have their hands tied on a lot of different things, both as to what they can do in terms of loans, but also when they're doing loans as to what they can agree to and not agree to. But we really approach it as an owner and as someone who does a lot of borrowing, and so we really understand the borrower's perspective a lot better than many banks do, and so we can offer a high degree of flexibility and ease of execution that is much different from dealing with a typical bank.
In Shimon's comments, he brought up Queens, and he brought up the subject of Flushing. Blackstone made a big investment in Flushing. Let's talk about your thoughts and what you did in Flushing and the retail market in general.
Sure. I mean, on a national perspective, what we've had experience investing, good experience investing in is kind of grocery and retail centers, power centers across the U.S. And then when we look at urban markets, whenever we have the opportunity to buy an urban power center, which is they're very few and far between, we usually take advantage of that opportunity. So when you look at the demographics around Skyview and Flushing, which you're referencing, the population dynamics are incredible. There's so much growth in the market, and there's very few places where people can go to shop and visit numerous stores. So for us, we see it as an opportunity to be an investor in an established community with a growing population, with access to transportation, and those opportunities are few and far between, so we take advantage of it. And it's an asset that we expect to own for a while.
Jason, when you do these condos today with your partners, what are you doing with the retail components? Are you selling them off as condominiums, or are you trying to lease them?
We typically sell them off. It's usually a very small component of the overall project return. So instead of going through the brain damage of leasing it up and having the TIs, LCs, we just take the condo and sell it off. In most instances, they're pretty small too. So we find that you get a lot of owner users in the demand pool. So given that, we typically don't lease, we just sell them off.
And what's your general feeling about the retail market?
Here in New York, I would say we like the high street retail, which is a little bit different than these guys, but i.e. Fifth Avenue, 49th up to the Park, and I would say the core part of Soho. We've bought a number of transactions
In Soho, I noticed.
in that core Soho, so along Spring, along Green, along Mercer. So I always say, if I can be within a block or two of the Apple store right there, we will take a look at that deal. We nationally probably don't like the grocery anchored type retail strip centers. The times when we have done those deals, they've been tough. So I think we personally think about retail, breaking it down. If your tenant base is going to be someone that competes with an Amazon, I think you're going to have a tough time today and going forward. And I just think about it at a personal level. I don't know about other people in this room, but if it doesn't come from Amazon or one of the other online delivery services, it doesn't come to my apartment. So if you are a tenant who does not compete with Amazon, i.e. I think that higher end luxury good type of store, then that's a type of tenant we want and the type of asset we want to own.
Ben, you have Dumbo Heights, which has a large retail component.
Yeah, we've been growing our retail business substantially recently.
And also Times Square, where you put National Geographic.
To echo Jason's point, I think the retail environment is shifting dramatically where it's been happening for some time now where people are buying more and more of their goods online. So retailers are trying to figure out ways to get people in the door, and that's created a lot of very interesting experiential retail environments, both in high street retail, I think in more typical retail environments like malls, and then also in Times Square, which we've purchased a deal about a year ago and have leased up to a lot of experiential tenants that'll really, I think, bring in a lot of the tourist traffic and create a great environment for them to go and enjoy the day.
Well, when we talk about Times Square, we have an enormous number of hotels. We have enormous number of hotels in the boroughs. I know that I believe Carlyle was involved and you sold the hotel component in Brooklyn.
We're in the market currently.
Right.
The Bourne, we have a Hilton.
So, and we know Blackstone, they had a couple of hotels over the time. How do you look at the hospitality market today?
You know, generally, I mean, you can't hide from the Airbnb factor in New York City. You have shadow supply of close to 100,000 rooms, just the equivalent of 100,000 rooms with Airbnb. We generally haven't invested in the select service business in hotels in New York City because of this supply and because of the new supply that's coming online, which is almost 30% of existing stock. That being said, if you can buy irreplaceable assets in New York City in the hotel sector, we're still very bullish because I think if you look year over year, tourism growth is plus or minus 4 or 5%. And that trend's continued through economic uncertainty around the world, what's happening in Latin America, what's happening in Europe, and that's a trend we expect to continue. So as tourism continues to grow, if you can buy assets that people want to stay in, you should be okay if you're providing a commodity product that obviously comes in.
Jason?
In New York, the supply is a concern. Both the actual new construction coming online and then the shadow effect of Airbnb. New York City, I think, in total has just over 100,000 rooms. So you're adding 30,000, and then Airbnb, you say 100,000. You hear numbers are all over the place, whether it's between 30 to 100,000, but as a percentage of existing supply, it's a humongous number. And obviously it has a very negative effect.
But we're very long-term holders and we're long-term bullish on the growth of New York City. And so for irreplaceable assets, to Qahir's point, we think it's still attractive.
So now I'm going to put you in the lender position. Since there isn't much money from banks, because the banks are very aware of Airbnb, they're aware of the number of new hotels on board, how do you think the Kushner companies would see to lend on hospitality? Because many of the hotels that have been built, the non-branded boutique hotels, have been funded by private equity and private lenders.
Well, I think it's a challenging environment that creates some opportunity, and it's all about being at the right basis and being comfortable that the long-term viability of that hotel is strong. We're long-term holders. In the debt business, it's a little different because you have a certain term on the financing, and so you need to have confidence that on the maturity date you're going to get paid off. And so it's all about being at the right basis, and it's a space we've been looking at very eagerly.
In another area that I know that you have involvement, and I'm going to ask the other two panelists, is that you're bullish on Jersey City. What do you see in Jersey City? I'm bullish on Jersey City, depending on the location. What are you seeing in Jersey City, and then I'd ask Jason and Qahir.
In Jersey City, I think we see a lot of similar things that we saw in Brooklyn 4 or 5 years ago, where it's very close proximity to New York City. The subway, depending on where you're going, whether it be Exchange Place, Grove Street, or General Square, is anywhere from 5 to 9 minutes to the World Trade Center. And the rents and the pricing there is a substantial discount to areas of Brooklyn and even Queens, even though the proximity is there. So you really view it as part of the fabric of New York.
Instead of 6,000 new units coming on in Brooklyn, Jersey City, they have about 17,000 new units coming on.
There's a lot in the pipeline. A lot of that is is planned versus actually under construction. But at the same time, there's a dramatic imbalance between the rents there and the rents in the rest of New York City. And we're seeing a lot of people moving into Jersey City, and for the right locations and the right spots, I think it's very attractive.
Jason?
We've taken a look at Jersey City over the years. We actually went through and basically did a zoning study, and you figure out the number of sites that are available that could be developed rather quickly, into millions and millions and millions and millions of square feet. So that makes us nervous.
But there is a need for affordable condos in Jersey City, which is the market that you like.
We do. It's, again, in a market where we go in, we buy a deal, and someone can immediately put up another 1 million, 2 million square feet of competitive product up against us. We don't.
But isn't that the same thing in Long Island City? You're investing in Long Island City. You know, just get on the 7 train. I went to the City Field the other day. Every parking lot or any vacant space is now a building. You know, in different areas. So we have the similar situation.
And we don't have any condos in Long Island City.
Let's go to another area. Something, you know, I gotta be stumped once in a while. Let's go to the Bronx. You know, what's your thoughts about the Bronx? You know, everybody believes that there's great opportunity. I had a show recently, Jeff Levine, who's never shy to say anything about his position. He said, you know, I'm building affordable housing in the Bronx, but right across the street from my project, 2 people just got shot and murdered last week. But that was Jeff, you know, because he wasn't an advocate of the Bronx. What's your thought about the Bronx? Market rate housing, new developments in the Bronx, industrial conversions, retail?
We really haven't been that active in the Bronx. We've had our hands full, but we've looked at some lending opportunities, and I think there are definitely pockets that are very interesting.
We're looking at a deal right now in the Bronx, but it's in the self-storage space. So we are active up there, doing deals there. On the housing front, I would say we've done the demographic studies and looked at it. We just don't think it's quite there. Maybe next cycle, but right now, from demos and job growth numbers, the numbers just don't. Given, you know, if you build a building in the Bronx, your hard costs are going to be the same as what they are in Brooklyn, in Queens, in Manhattan. Manhattan slightly more, but it's the same hard costs, and on the revenue side, you just don't have the same numbers to support the deals.
I mean, we're generally not developers. I think we're very supportive of more affordable housing, more housing in general. The stock growing in New York City, so to the extent that economically it makes sense, we're fully supportive of it.
So in vein like that, one of the areas that has an opportunity for more housing, affordable housing, is the home of the future wheel, 540 feet high, and a outlet center, Staten Island. What's the thoughts of any of you on the opportunities in Staten Island?
For us, similar. We haven't spent much time on Staten Island, but
yeah, we've looked at it, and I always think of Staten Island kind of. I know it's a borough, but if you look at the housing that's there, it feels more like New Jersey than it does New York City. It's just a lot of single-family housing. So if the numbers are right, we'll look at it. But in general, I'd say we probably prefer to be in Brooklyn and Queens and Manhattan before Staten Island.
Same family. Now, a lot of people who live in Staten Island work in Lower Manhattan. So it brings me a question on Lower Manhattan and the office market. I know that you recently you bought 44 Wall. What's your position? What's the thoughts about the office market? Because the office building sales are going up, as Shimon said, 13%, and a B building today is probably selling in the range of $800 a foot, a B minus building. What's your thought about the office market, especially with regard to the fact that there's an enormous amount of space being built in Hudson Yards, and then there's also a lot of space in Lower Manhattan?
Yeah, I mean, I think we see Lower Manhattan as a part of New York City that's seen massive infrastructure investment. population growth that's averaged, I think, around 20% a year, starting on a very low base, obviously, but the population continues to grow, office space continues to get absorbed, and we saw an opportunity to invest in a B office building where we didn't need $90 or $100 rents, and the opportunity was to actually just buy it, make it a little better, lease it up, and then sell it. So we remain optimistic if you look at the number of transportation lines that go into downtown Manhattan and the amount of that's being invested in infrastructure and the proliferation of retail. It truly has become a 24/7 kind of environment over the last 10 years, and it's a trend that we expect to continue as the city's population grows and as housing grows downtown.
But you've also been one of the largest purchasers of office buildings last year.
Yeah, I mean, we look at New York City, Manhattan specifically, and look at office, and we still see it as a good place to invest. We continue, as I said, we continue to see this urbanization trend where people want to work in urban centers. So you're seeing an influx of companies. We tend to invest, we really like, obviously, the Plaza District, because you're not building a lot of new supply in the Plaza District. It's accessible to all sorts of transportation, and tenants really want to be there. So what we do is we see office as a very interesting investment because supply is growing, but it's growing on the west side, and it's growing downtown, and it's growing at rents that are significantly higher than the product that we're buying. But
Jason?
Yeah, I would say our view on office really you have to look at it in context of your earlier question in terms of what inning are we in. As I stated earlier, I think we're seventh inning, and for us, our main book of business is out of our opportunity fund, seeking 20% returns, and the hold period is 3 to 4 years. So if you think you're in the seventh inning and you have a 3 to 4 hold period, it's tough to go by an asset class like office. It's obviously extremely highly correlated to GDP growth.
Now, last year you bought medical office space.
We did. We bought a couple office buildings. So the base of the Corinthian on 37th and 2nd. It's about 100,000 square feet, but there it's a unique play where we're going to convert that office condo. Again, our expertise in condo. So, and that's a business. Doctors can get very attractive financing through SBA loans, 80%, even 90% in some instances, at very cheap rates. So we think that makes sense for doctors who are worried about losing their space and obviously get the long-term capital appreciation on buying after they buy the asset. So we think that's going to be a good deal. We also bought another office building on 33rd Street, 18 and 20 West 33rd, and that as well we're going to convert to office condo. So we'll play in that space, but a traditional office deal, I think, just given our view of where we are in the cycle, to be able to hit 20% returns in that 3 to 4 year hold period, I think it's just difficult from an underwriting point of view.
So I'd say in the last 50 minutes we've accomplished quite a bit on a lot of different topics, and I'd like to open it up to certain questions from the audience. Yes? Would you stand up so people can hear the question?
I think there are increasing indicators that we may be leading to a tech bubble because your company also does some in DC and have the investment in Brooklyn. I think the markets that are most affected by this are office, residential, and San Francisco. I'm wondering, I know you guys are long-term holders, how is factoring into your underwriting of the company?
So the question is about whether we're in the late stages of a tech bubble and how it sort of impacts our underwriting in the short term. I think, I don't work much on the leasing side, so I can't really speak to that. But I think what we're seeing in terms of the tenants that we're attracting in our spaces in Brooklyn is much broader than just technology companies. It's a lot of creative companies, whether it be Etsy, which is kind of a technology company, but it's also very, it's a creative retailer. Whether it be media companies, it was in the press that Rolling Stone is moving to Dumbo, so that's another indicator of the creative companies moving. So I think we're less focused on attracting tech companies and really attracting creative companies, and we think long term that'll be sustainable.
Other questions? Yes.
Yeah, I have a question. I have a question about access to transportation, specifically in Brooklyn, with the emergence of the BQX Brooklyn streetcar plan. and also that they announced that they plan to shut down the L train. What impact do you think that will have, any of you, on the individual consumer and their plans to invest in that borough, and also
Our building in Williamsburg, I actually don't take the L train. I take the E train to Queens, which takes 5 minutes, and then I'll either take an Uber or I'll take a cab down to Williamsburg.
Or you can do the ferry.
Or you can take the ferry. And so I think there's a lot of ways to mitigate the L train shutdown. So for our building and for others, there could be a shuttle that takes people from Williamsburg to other subway lines. So they think the L train, while will create a lot of short-term pain, I think very much long-term, it should be a net positive for them.
Yeah, as an investor, again, I think it goes to your hold period. So are you a short-term, go in, create value, flip type of investor, or are you long-term? If you're more of a long-term holder, it's long-term a good thing. If you're a short-term, will there be an opportunity where someone's a landlord and owner is worried about this and just says, I don't even want to think about this, I'm going to sell, maybe sell at a price that's slightly below market, then it might be an opportunity. But long-term, it's overall a good thing to get that train fixed.
I'd like to try to answer that. One of the benefits that has helped Jersey City is the light rail, because it's been able to increase the access for housing in Jersey City, which has been very beneficial. But there they had the infrastructure on the land. It was a different type, and it was a smaller structure. Here, depending on if we look at how long it took to do the Second Avenue subway, the light rail in Brooklyn, Queens may not be around for a number of years. So I wouldn't count on it in 2020. You know, you have different administrations, you have MTA, you have a variety of things. So to count on that might be a pipe dream. Any other questions? I would like, oh yes.
What are your views on micro units and co-living? Any of them?
I think the question is, what is our view on micro units and co-living? In terms of, as you talked about earlier, providing additional affordable housing in New York City, I personally think it's a fantastic option and something that we should be thinking more about. So we've looked into it, just the zoning just doesn't allow it. And there's been a couple specific instances where we've tried it, and from what we're hearing, because they're just now to lease up, is it's going well. So if we would be big supporters of getting those rules changed and allowing more of that micro housing. It's just people, especially again going back to millennials, millennials live with less stuff and they don't want this stuff. So if you can give them a bed, a flat screen TV, in some instances not even a flat screen TV because they have their iPad or other mobile device, they just aren't. We don't need as much space as we used to. So I definitely think that it is an asset class that makes a lot of sense in a dense urban place like New York City, and something that we should take a long, hard look at.
We've seen that all the time in our apartments in the village, where we've had a lot of success taking one-bedroom apartments and turning them into three-bedroom apartments that are very, very small, efficient units, and they get much better rents than the one-bedroom apartment because people are really focused on what's my price per bed.
In the East Village, there's more co-living, in that room basis that effectively the rent is probably over $110 a foot. When you take a two-bedroom, I've seen a one-bedroom converted to 4 bedrooms. There's no room over there. You don't have the WeWork co-living concept of amenities. Your amenities is a refrigerator, a wine cooler, and a washer dryer. But many of the very successful landlords, as well as the Kushner companies and others, have been rather successful in this vein. The biggest problem, Todd, is the administration with the harassment, with the current matter, which a couple of landlords are under scrutiny, which is something that Blackstone wouldn't get involved with. No, I mean, in general, and that's the negative of the co-living. Okay, I'd like to thank the three of them, Shimon,